we show the support on gold around 39.50. I think you got a good shot at this reaching a low this week to next week seasonally, and that's basically where it goes. And you would then expect it to probably rally after this period, going into August.
It's been an interesting picture this past week. Gold remains above $4,000 an ounce, but has been on a slide. Copper continues to benefit from growing demand linked to AI, defense, and energy infrastructure. Yet investors are also facing geopolitical tensions, stubborn inflation, and rising government debt. Well, Martin Armstrong is a forecaster and founder of Armstrong Economics. He has spent decades studying capital flows and major turning points in financial markets. He joins us now on Top of Mind. Martin, thanks very much indeed for your time.
Oh, thank you for inviting me.
Well, look, it really has been an interesting few weeks. You often argue that capital flows tell the real story, right? I mean, since the Middle East conflict intensified, we've seen the US dollar remain resilient, US equities continue attracting capital, and gold pulling back sharply. I want to know from you, Martin, which of those market moves best supports your theses and which of it challenges it the most? How have you seen this context?
So what you're seeing right now is basically you have a lot of geopolitical tensions building also in Asia. Mm-hmm. So there's been capital inflows to the dollar from Japan, as well as from, Taiwan and Southeast Asia in general as well. So that's what the capital flows show. As far as the geopolitical issues in the Middle East, a lot of people think that the embargo, they listen to the propaganda that, the blockade will cause Iran to collapse. And that's just not the case. But the other thing that people have ignored and are maybe not familiar with, you mentioned debt. We may find the first crack in the sovereign debt crisis in the Middle East. Most people don't realize, but during COVID, oil went down to $6.50. That's when all the Gulf states ended up borrowing extensively. So what Iran is really doing with attacking Dubai and the Gulf states is that if you cannot service your debts, because you can't sell the oil, then you're looking at, I believe it's trying to create a banking crisis. And, the Western press doesn't seem to even understand that. It's all about tankers, in the Straits of Hormuz, etc. But so, I mean, Iran is playing pretty much 3D chess at this stage. They clearly made the largest stockpile of ballistic missiles. Sources that I have there have basically said that they still have probably 70% left. They've used drones and changed warfare in the sense that by sending waves of drones in, it forces Israel, etc., to shoot up Patriot missiles, which cost, over $1 million a piece to take down a $30,000 drone. So Iran, I think, people at this stage in the game, gold is backed off. It should find a low here, even seasonally, within going into next week at the latest. Right. And then it looks as though the geopolitical side is going to increase going into August.
Let's just go back very quickly. At the start of the year, markets were expecting several Fed rate cuts, right? Today, investors are increasingly discussing the possibility of no cuts at all and even another hike. You see what's happening with some of the rate decisions recently. Does higher for longer strengthen your sovereign debt concerns, or does it suggest the global economy is proving more resilient than many had expected?
Yes, look, see, I know a lot of people focus on the U.S. because it's, the biggest debt. In a sovereign debt crisis, the U.S. will be the last one standing.
Right.
If we look at it from a more practical perspective of not debt to GDP, but government to GDP, I believe that's the real test. So if you look at the United States, about 35% of GDP is consumed by government bureaucrats. In Europe, it's 52%. It's one of the highest in the world. And this is why you look at Europe, their economic growth is about half that of the United States. Europe is in serious trouble. And this is also why they're pushing for war as a distraction, because if they fail, and you're starting to see a lot of tension, even Italy has told Brussels they should be issuing debt because they're having difficulty selling it.
Yeah.
And that's the real problem. They keep pushing, Ukraine with war and Russia. And
they also have rising defense commitments, don't they? I mean, they have to spend money in defense, isn't it?
Yeah, this is, I can tell you that Macron went to go meet with Xi before Trump did. And what he said was that Europe is no longer going to defend anything outside of its own territory. So no Middle East, but he specifically told Xi that they will not interfere in Taiwan. So that's why Taiwan became a real issue at that stage in the game when Trump got there. All right, Europe's not going to. They're giving us the green light. What about you? And after that meeting, if you read between the lines, Trump said, I suggest chip companies move to the United States. So I really, I think honestly that Trump is not going to come to the rescue of Taiwan. So I would be concerned about that on a geopolitical level. And they may take action even before the U.S. election. So you could possibly see an increase in this activity both in Asia and in the Middle East by August.
Now, I want to chat about what all of this means for something like gold, right? And it's quite interesting. Gold has fallen from $5,000 an ounce earlier this year to roughly about, looking at it today, $4,150. Now, given the ongoing geopolitical tensions, the rising deficits that we are speaking about, debt concerns, why isn't gold higher right now? I mean, what is the market seeing that gold bulls may be missing? How are you digesting this, Martin?
Gold typically, look, everything has a cycle to it. And gold historically has a very seasonality to it. And it tends to, June is historically when it often makes the lows and reverses afterwards. The markets are, I would say, the press is always, downplaying Putin, he's losing, etc. The Middle East, they keep saying that, Iran's losing 200 million a day. They can't last much longer. So there doesn't seem to be a consensus that this will expand more. So they tend to think, I think it's like, okay, fine, it's all over with, and we show the support on gold around 39.50, and I think you got a good shot at this reaching a low this week to next week, seasonally, and that's basically where it goes. And you would then expect it to probably rally um, after this period, going into August. And a lot of people, we need something in the geopolitical sphere to make people think twice. And that may be China going after Taiwan, since Macron said, we're not interested, do what you want to do.
Well, sticking on gold, one of your more unconventional views is that the stocks and gold can rise together, with equity markets still holding near historic highs, while gold remains well above where it was, let's say, a year ago. What is that combination telling you about investor confidence in government debt now? Can you just reconcile that for me?
Because it's basically, a lot of people look at like the Great Depression, but you have to know the facts. All right. In 1931, virtually all of Europe, South America, and a lot of Asia, including China, defaulted on their debt. U.S. did not. So it sent the capital to the United States, pushed the dollar up dramatically. All right, so that creates the deflation. All right, so stocks went down. You ended up with people hoarding money. That's why Roosevelt confiscated the gold. And when you end up in a financial situation, it goes in two directions. One, either the private sector's in trouble or it's the government side. So in 29, the stock market went down by 90%, granted, but the government did not. Okay, so this time it's the reverse. Why would the stocks and gold, hold up? Because we're in a sovereign debt crisis. Then you're talking about war. Going into war, they just issue more and more debt. All right. Do you really want to buy their debt and sell all your stocks and gold? I mean, that's basically it. So when the government is in trouble, it's basically all tangible assets that survive. So that's gold, stocks. I'm not talking about the IPOs that have nothing, but the blue chip stocks that really have value to them. Even real estate. That's why they've been calling it the last few years the everything bubble. That's an indication people are just trying to get money off the grid. They don't trust the banks for a lot of various different reasons. So that's why gold and stocks tend to go up during this type of period when you are in a situation where you don't trust government.
Maybe it's a good point for me to come in there and ask you, mining investors chiefly, they hear two competing stories when they look at what's in front of them, right? Slowing growth, economic growth on the one side, and enormous demand from AI infrastructure, defense spending, electrification on the other side. So it's a toss-up between both. When you look 5 years ahead, Martin, which force do you think is going to win there?
We're looking at a general expansion of the economy into 2032. The AI, a lot of people have gotten wrong. They thought, with AI, you're going to see unemployment rise, jobs replaced. Not true. We have probably the first real AI system devised. It's got over a 40-year track record. The computer writes over 1,500 reports on instruments around the world every day, all by itself. There aren't that many analysts in the world to do so. All right. So it has increased our productivity. And this is what people are now finding. We have some of the major institutional clients, and I told them it's going to have the opposite effect of what people are saying. And what I hear from them is, you're absolutely correct. We haven't laid off people. It has increased our productivity. So it's not, going to replace a lot of people. It's not quite the same as the internet that replaced a lot of local stores and malls, etc., with Amazon. This is increasing the productivity. And so corporate profits have actually tended to rise a bit more because of this. So it's having a different effect than the dot-com bubble.
Some fabulous insights. Thanks very much indeed, Martin Armstrong, the forecaster and founder of Armstrong Economics. Martin, it's been a pleasure. Thanks very much indeed for giving us the time.